If you handed a random person on the street a check for $50 million, you'd assume their financial worries were over forever. They've won the game. They're set for life, and probably the next 3 generations after them. Except statistically, they aren't. In fact, there is a specific repeating mathematical anomaly in modern economics that says within 7 years, that person is actually more likely to end up completely bankrupt than the average citizen. It shouldn't be possible. You have to actively try to burn through that much cash, and yet it happens over and over again.
Most people think they know exactly why this happens. We blame the flashy sports cars, the mega mansions, the sudden entourage of long-lost cousins, and the inevitable bad investments in a friend's doomed restaurant franchise. We look at them and think, if it were me, I'd just buy an index fund and live off the interest. But that's not actually what's happening.
That's just the comforting lie we tell ourselves to feel smart. The truth is much stranger and significantly more terrifying. The collapse of sudden wealth isn't a story about reckless spending or lack of financial literacy. It's a story about a highly sophisticated, invisible ecosystem that triggers the moment the ink dries on the check. To understand how deep this goes, we have to look at what actually happens the day someone wins a major lottery. Before the winner even steps forward to claim the prize, a massive apparatus springs to life. In many jurisdictions, law dictates that lottery winners' names are public record. It's marketed as a measure of transparency, proof that the game isn't rigged. Suddenly, a completely normal person, someone who used to worry about the grocery bill, is thrust into an arena they didn't know existed. They aren't just rich, they are publicly, undeniably liquid. And in the financial world, raw, unallocated liquidity is blood in the water. But that raises a bigger question. Even if you have people knocking on your door asking for money, how do you lose tens of millions of dollars?
You can buy 5 Ferraris and 3 houses and still have $40 million left over. To go totally broke, to hit absolute zero, requires a complete structural failure. It's as if the money itself possesses a strange, radioactive property that actively destroys the environment around it. Why does wealth acquired instantly behave entirely differently than wealth built slowly? What is really going on inside the mind and the bank account of a sudden millionaire? Here's where things get interesting. The moment the money arrives, the winner's social fabric doesn't just change, it completely ruptures. When you get rich slowly, your social circle shifts gradually. You adapt, and your friends are usually in a similar economic bracket. But when it happens in an afternoon, you become a walking ATM for everyone you've ever met. If you say yes to your brother's mortgage, you have to say yes to your cousin's medical bills. If you say no to your childhood best friend, you're the arrogant snob who forgot where they came from. It turns out, saying no to the people you love is incredibly exhausting. It's a psychological tax that no one prepares you for. So, to escape the pressure, many winners do the most logical thing they can think of. They look for professional help. And that's when they walk straight into the trap. The people who end up destroying the winner's wealth usually aren't the winners themselves. It's the professionals they hire to protect it. If you suddenly have $100 million, you don't put it in a standard checking account. You need wealth managers, tax attorneys, and accountants. You are forced to outsource your life to an elite class of financial gatekeepers.
But here is the hidden incentive. A lot of these predatory financial advisors don't make money when your wealth sits safely in an index fund. They make money on commissions, high-fee private equity deals, and exotic tax shelters.
The winner thinks they are buying insurance against their own ignorance. In reality,
They are just handing the keys of a hypercar to people who get paid based on how much gas they burn. The obvious explanation is that the winner was greedy. The hidden explanation is that they were hunted. But that's not the real story. Psychologists have a term called wealth elasticity, but it's easier to think of it as your internal financial thermostat. If you grow up middle class, your brain has a deeply ingrained blueprint of what things should cost and what a safe amount of money looks like. When you bypass the years of struggle it takes to build a business, you miss out on the emotional calluses required to manage large sums. To your brain, an infinite amount of money feels exactly like a moderate amount of money. It just feels like it will never end. The weirdest part? The human brain processes sudden wealth similarly to physical trauma. It triggers a profound disorientation. When you can buy anything, choices lose their meaning. When choices lose meaning, status loses meaning.
To feel something, anything, winners often subconsciously start sabotaging their own success just to get back to a baseline where the world made sense. They don't lose the money because they love luxury. They lose it because on a deep, primal level, the money is making them miserable. The sudden wealth trap is actually a perfect microcosm of a much larger shift happening across our entire economy. We live in an era of unprecedented, rapid financial acceleration. Think about crypto millionaires overnight, meme stock traders, tech founders who go from a garage to a multi-billion-dollar valuation in 24 months, or even young influencers suddenly pulling in corporate executive money. We are manufacturing sudden wealth at a scale humanity has never seen before. And we are seeing the exact same psychological and structural collapses happen to 23-year-old day traders that we used to see happen to Powerball winners. The systems designed to extract wealth from the unprepared are getting faster, smarter, and more aggressive.
The financial plumbing is rigged to ensure that money flows away from those who didn't build the infrastructure to hold it. It makes you realize that our entire cultural obsession with the big win, the idea that all our problems would vanish if we just hit that one massive payday, is built on a fundamental misunderstanding of what money actually is. Money is an energy system, and if you pour a massive amount of energy into a structure that hasn't been reinforced to handle it, the building doesn't get bigger, it just explodes. Which leaves us with a lingering question for an era where everyone is chasing a shortcut to the top. If you actually got the sudden fortune you've been wishing for, would it actually set you free? Or would it just expose the fact that you have no idea how to survive the system you just broke into? The next time you see a headline about a multimillionaire losing it all, don't laugh, because the trap that caught them isn't greed. It's a mirror of a financial system that knows exactly how to take back what it gives.